Hey everybody, annuities keep hitting new records, and so I wanted to talk about the latest records and then actually show you why. So if you're afraid of the word annuity, you might want to pay attention to this. All right, here's the thing. Fixed annuities, MYGAs, multi-year guarantee annuities, halfway through 2024 have already hit 83.1 billion with a B dollars. This is not big institutional money. This is all individual investors, okay? That's the top, that's the big boy. And then the second biggest one out there is fixed indexed annuities, $58 billion. These are all new records. Halfway through a year, that's a tremendous amount of money going into these types of annuities, okay? Then the others, it falls off from there quite a bit. You got registered indexed linked annuities. These are a new version of variable annuities, and they've actually taken over the variable for the first time. They've been rising because the traditional brokerage houses still like to use the variable annuities for some reason. I'm licensed to use them. I have them all. I have access to everything, but I don't find a huge reason to use either of the registered indexed linked or variable, because the fixed indexed are certainly better than the registered indexed linked in most scenarios. And then there's the immediate annuities and deferred income annuities, which actually kind of blows me away that they're only at $2.9 billion. I live in Arizona, where there's dinner seminars selling them to any taker out there. Kind of the reason that annuities get a bad name. And it's such a small part of the market. The dinner seminars, I guarantee you, are not selling these MYGAs, these fixed annuities. The commissions are tiny on them, and that's why most advisors won't even use them, even though they're the best safe, quote unquote, best safe investment out there right now. And money's flowing into those top two right there very quickly. So let's talk about them. So the MYGAs, why are they so popular? Well, the reality is it is the best place right now, and I know my head's in the way. I'll move it. It is the best place for you to find and lock in a higher fixed interest rate. Okay, so you compare these MYGAs, these fixed annuities, with things like bonds and CDs. They are comparable. They are fixed rate investments for a fixed period of time. They do not have any fees. So just like a CD at a bank, you're not going to be paying fees out of this account. Very important, okay? There is a new contingent of advisory fixed annuities out there that might pay a slightly higher interest rate, but if your advisor is taking 1% in fees out of it, you're not making anywhere near as much as the ones with truly no fees. So be careful about that. I've seen CDs in investment accounts charging a 1% management fee, and it makes no sense. So fixed annuities, CDs, they should be outside your portfolio, and they should certainly not be charged a management fee, because nobody has to manage that. Okay, here's the huge advantage. Other than higher interest rates, the huge advantage is these are investments that you're allowed to pull money out of every year. You're allowed to take money out. So the problem with CDs, you're forced into shorter terms or laddering or things like that because you have no access to the money. And when you properly design a portfolio, you need to have access to safe investments when the stock market's not doing well, so you can fund your retirement. These are primarily meant for retirees because they're giving you access to this money. Okay, very important to understand. The regulatory world, they went and passed this through Congress that all the annuity world is tax deferred, which means you're not allowed to pull money out until 59 and a half. So if you're over 59 and a half, you're allowed to pull money out of these. If you're under 59 and a half, just like your 401k, IRA, you're going to get penalized 10%. So that's why these are really geared towards retirees. You look at the typical terms out there, you have 3-year, 5-year, 7-year, and 10-year. 10-year right now is the best one. These interest rates are moving quickly right now. We've had lots of lowering of interest rates, but notice this. Way better than CDs. I just looked at these rates out there. You're looking at anywhere of a half to a full percent better than any CD you can find out there. Now, depending on when you're watching this, these change all the time. So just understand these fixed annuities are regularly a half a percent to a full percent better. The default is that they are compound interest and tax deferred. Okay. There are small amount of non-compound simple interest, and that's why the asterisk there, that's 6.1, 6.15, those are simple interest out there. So if you're using your money, simple interest is great. If you're leaving it in there and letting it grow, you want compound interest. That's the difference maker. So for some retirees, you can get a higher interest rate by accepting simple interest because you're actually going to take the money out anyways. And if you're taking the money out, you don't need compounding because the money's not going to be in there to compound in the first place. So don't be afraid of simple interest if you're using it properly. Very important. So there's a reason these are so popular. I hope you see that. If you put these side by side against any bond out there and any CD out there, you're going to select this if you're going in this with a clear mind and no biases. That word annuity scares people off, but I'll be honest, there's billions of dollars going into these things. They are very popular and they do exactly as they say they're going to do. They're not what's getting sold out there and where the bad name comes from. All right. The next part of this is the fixed indexed annuities. And the reality is I always talk about building a safe portfolio as much as I build a stock portfolio. You shouldn't just have all your money in one safe investment. You should have a portfolio of safe investments. We need to be able to handle inflation. Owning a whole portfolio full of bonds, you're going to have an anti-inflation portfolio. You're going to lose money when we see inflation. Whereas this fixed indexed annuity is going to perform significantly better when it comes to inflation, and especially nowadays. The ones 10 years ago, the ones 5 years ago, they were allowed to change their interest rates. Well, now interest rates are higher, and they created products that are guaranteeing the interest rates for the whole term, which is fantastic. We can now rely on these. This is so much better than the fixed indexed annuities of the earlier years. And what a fixed indexed annuity is, well, think about an investment just like that MYGA that gives you just a flat fixed interest rate, but also gives you other ways to earn interest. They tie it to the stock market. It's not invested in the stock market. So they're only paying you interest based on how the stock market did. So here you have the S&P's 500's multi-asset index. So not just the 500 stocks. No, they have a multi-asset index that they produced at the Standard & Poor's. Fidelity's multi-factor, and there's the NASDAQ, okay? The multi-asset has a risk control. It's a very tame index and hasn't done well the last couple of years. But has it had great years? Yes. They're giving a participation rate, no cap, no nothing, of 190%. Basically, you get double whatever the index does. So when it goes down, you earn nothing. Okay, but I can put some of my money in there. I can put some of my money in the Fidelity. I can put some of my money in the NASDAQ, and I can put some of my money in the fixed rate, and I get to change my allocation every year. 75% of the NASDAQ 100 with no risk and no fees, I'll take it. When the market goes down, because we know the NASDAQ can be volatile, we won't make anything. But when it goes up, we get 75% of whatever it goes up. And we don't have fees in here, and we don't have risk in here. This is a much better safe investment for a portfolio that is built just not to lose money and do the best it can to keep up with inflation. If you're relying on the yield to fund your retirement, this is not the right safe investment. But if you need safe investments that you can withdraw from when the market's not doing well, this is 10% access annually, no fees, no risk, and we can change how we're earning interest. We don't like the look of the stock market. We can just sit in the fixed interest rate. Usually not as good as the MYGAs out there, but it's a reasonable fixed interest rate for the market. Okay, so that's what's nice. And now they won't change these interest rates on you if you get the right ones, because there's still plenty out there that are allowed after you get in to change their interest rates year to year. And their reasoning is that you're allowed to change how you're investing it. So therefore, they need to change how they're investing it. So they need to be flexible in their interest rates. Well, yeah, no, that just means they're going to gradually move them down. And that's why I made a video about upgrading your annuities, because what's available today is way better than any of the stuff that was available previously. So that's the thing. Investing changes. We can't just have our blinders on and all of our biases keep us from looking at stuff that is reasonable. And this is a very reasonable part of any safe portfolio. You must build your portfolio for safe investments and build your portfolio for stock investments. No different, right? We want to have some diversification of types of safe investments. A fixed annuity and a fixed indexed annuity. And depending on how big the safe portfolio is, some bonds maybe. You know, I just built one the other day with some municipal bonds because it was a whole bunch of after-tax money. So there's always parts and pieces that we should be building into these portfolios. Picking up on these higher fixed interest rates is great. So both the fixed and fixed indexed annuities, your principal and credited interest is guaranteed. Your money grows tax deferred and compound. You may have access through penalty-free withdrawals. Virtually all of them out there give provisions, and most of them are 10% access each year. So your anniversary, it opens up a fresh new 10% access. They're creditor and lawsuit protected. Their 100% gets passed to your heirs. Okay, so this is a cash value investment. All the growth that's in there, whatever the value is when you pass away, goes straight to the heirs. No fees, and this is where we're seeing a huge migration from the bond funds. Bond funds go to fixed indexed, individual bonds go to fixed because of the varying of the growth parameters. Unique to the fixed index, that's where you get the market-based growth without risk of loss. That's why it's going to do better at keeping up with inflation, okay? And there's multiple ways to earn interest, and we can choose how to earn interest annually and change it. And so that gives us a lot more flexibility to handle whatever's thrown at us in the future. So I hope that gives you a reason and an idea of why these fixed and fixed indexed annuities continue to break records, because right now, the way we look at the safe investing world, yeah, you can use a little bit of bonds here and there, but you can't use it as a blanket safe investment anymore, and especially for retirees. These are great diversifications, and people are using them more and more and more, which is always good to see, because that means the biases are starting to get stripped away. Always happy to help. Yourinvestmentcounselor.com. You can schedule a free 30-minute meet and greet on there. Our full class, full education, I do live over Zoom. So always happy to interact with everybody. I do a Q&A at the end of every month on every topic that we do. Go visit fpfeaz.org or shoot us an email or give us a call anytime. Always happy to help. Thanks for joining us. Subscribe, like, comment. I'm always happy to field all of them. Thank you. See you next week.